Hello, let us get to understand the cost of sales, or what is commonly known as the cost of goods sold. Okay, this is the carrying amount of the inventory sold. What do we mean by this? It is the amount, is the cost of the inventory that we have just sold. Okay, so the moment we sell the inventory we had, that is inventory, remember, is those goods that you have bought, that you have in the business that you intend to sell. And the moment you sell, you need to recognize the cost of sale, which is an expense, So you no longer recognize those goods as inventory because they have moved out, but now you recognize it as an cost of sale, which is an expense. Why? Recall the matching principle. It requires us to make sure we recognize expense, the cost incurred to earn that revenue that we have generated. So at every particular point in time, when we sell something, we earn revenue. Once we earn that revenue, we need also to recognize the cost incurred to earn that revenue in the same accounting period. So once you recognize the revenue, that is the sales revenue when you sell, then you also need to recognize the expense, the cost of selling. That is the cost of buying those goods that you have sold. So that is basically what we refer to as the cost of sale. And let me show you practically. We are saying the moment you buy or manufacture goods, remember this you record as inventory. Remember, this is an asset account. This is a current asset account. You have these things in your warehouse or in your shelves, and as at that point we are saying this is inventory because they have an economic value because you bought them with money. Okay, so they sit in your business as inventory. The moment you sell at this particular point, you recognize revenue, that is the sale revenue for selling these things. You also need to recognize now the cost of sale, which is basically the cost of goods, the cost of buying those goods that you have sold. This is an expense that you incurred in buying those goods. For example, if let's say you bought goods worth $4,000, okay, and now you've sold these goods at $6,000. This is the revenue, okay, that is what you earned from selling those goods. And $4,000, which is the amount you bought, this is the buying price. This is going to be the cost of sale. That is the cost of buying those goods that you have sold. Okay, so let us look at, we usually have two inventory systems that we use, that are used. That is the periodic system and the perpetual system. And the only difference that is there is at the point of recording. Remember, we recognize cost of sale the moment we earn the revenue, but we can decide to record it at that particular point that we have generated that revenue, or we can just make sure at the end of the accounting period, we make sure we record it. Okay, remember, we recognize as at that particular point that we have made that generated that revenue, but we can record it at the end of the accounting period, as long as, remember, it matches the matching principle, which requires us they be in the same accounting period. Okay, so it is a matter of the time when we record. And for the perpetual system, we basically record as at that particular point that you sold. That is where you're going to see there is a journal entry to debit the cost of sale account and to credit inventory, that is to reduce the inventory that we've sold. But now I want us to look at the periodic system. We have tackled the perpetual system in another video. You can just check it out. Today, let us look at periodic system, specifically when we are dealing with a trading company, that is a company that is buying finished goods. That is a company that is buying finished goods to sell. We are going to look in the next video for what happens for manufacturing companies, but this one is one that is buying finished goods to sell. So the cost of sale is basically going to be the opening inventory. Okay, that is the inventory that is there at the beginning of a certain accounting period. We add the net purchases. We are going to look at what do we mean by net purchases, and then we less the closing inventory. This is the inventory that is there at the end of the accounting period. Remember, for the periodic system here, we do the we do the physical stock count to check what do we have at the end of the period. Okay, so we are going to less this means this is what is remaining. This is what is remaining as at the end of the accounting period. So we are able to see the cost, we are able to see the goods that we have, the goods that we have sold during that period. Okay, so let us look first at the net purchases. The net purchases are, you could have the purchases that you've bought, that is the price of the goods that you bought. Let's say for example, you are buying cups. Okay, so the cost of the cup. Okay, let's say you had imported this, so there is the carriage inwards, there is the freight cost, freight, that is the cost that you've incurred to bring in those cups into your business, into your warehouse. Okay, so that is what you are calling the carriage inwards. It could be the import duties or the custom duties that you paid for at the when you are importing. And then you also less purchase returns. You could buy something and it is spoiled and you have to return it. So if you had already recorded it, you need to less the purchase returns. So basically, this is what you're seeing here being called the net purchases. It includes the carriage inwards, it includes import duties, all the costs that are directly coming into bringing this good into your warehouse are what we are calling the net purchase. Okay, remember to less the purchase returns in case you purchased something and you have to return it, okay, to the supplier. So for example, let us look at an example. We've been given the opening inventory. You've been given the purchases that have been done, that is the buying that has been done during the period of the inventory. Okay, then we have the carriage inwards. Remember, this is basically the cost of bringing in, that is the carrying, the logistics of bringing in these goods. Let's say you are importing them from from outside the country, so you have the cost of getting them from that country to your country, to your warehouse. Okay, these are still included in the cost of sale. Then we have, you less the purchase returns. Remember, if you had already recorded this purchase, then you need to remove it, okay, because you've returned it. Okay, and then we have the closing inventory. So how do we calculate this? We basically take our opening inventory, which is 20,000. Okay, so our opening inventory is 20,000. That is what we had at the beginning of the period. We add the purchases. We add the purchases during the period, which is $80,000. Okay, then we are going to take the carriage inwards. Okay, we add the carriage inwards, which is 5,000. Then we are going to less purchase returns. We are going to less purchase returns and also less the closing inventory, because this is basically the inventory that we still have in our warehouse. So basically this one, it's still in our warehouse. It means it has not yet been sold. So when we add this, you're going to have 105,000. Then we less 3,000, and then we less 15,000. We are going to get our cost of sale as 87,000. Okay, so basically remember, the cost of sale, the key things you need to know is the cost of sale is not the selling price. The cost of sale is the cost of buying the goods that you have sold, and we recognize it at the point of sale. At the point of sale, before we sell the goods, they sit in as inventory, and when we sell, now we have to recognize the expense, which in this case we are calling the cost of sale. Okay, and when we take revenue, we less the cost of sale, we usually get what we refer to as the gross profit. Okay, so in the next video, we are going to look at the cost of sales when we are looking at a manufacturing company. Okay.